Welcome to the Property Couch, where each week you get to listen to two of Australia's leading experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel and Escape from the City on the ABC. And Ben Kingsley, Chair of Property Investors Council of Australia and the founder of the 2018 Property Investment Advisory Firm of the Year.
Alright folks, you're on the Property Couch where each week Ben and I bring you the insider's guide to property finance and money management. Hello Ben.
Big week, mate.
In the shadows of a very, very big week.
Big week.
Yeah.
It started last Friday, didn't it?
It did start last Friday, around lunchtime.
Yeah. So we got, the Labor Party told us what they're going to do. They gave us their intentions. I did put out a press release for Picker about a month earlier asking for Labor to come clean in regards to telling us what day, what were their plans were with negative gearing. And
he responded to your request.
Thank you, Mr. Bowen. Thank you for at least letting us know. So now we know what we're dealing with.
1120.
Yes, 1st of January 2020. So that's what if they win government, and they've still got to get it obviously through the Senate. All of those things still have to play out, but at least we've got an idea of what they're trying to do.
And of course this week was the budget, Ben, as well, which was delivered on Tuesday night.
Yes, so Tuesday night budget, not a lot there, steady as she goes. Cash splash, which is what we expected. I think, if I was a betting man, Bryce, there's still 3 billion, I should say, in the unknown basket. Is there something in there for first home buyers?
Gifts, you reckon?
Is there a first home buyer incentive that might kick in the election campaign for maximum impact? So obviously the maximum impact they wanted was that they're moving towards surplus. They're definitely not in surplus this year, but they're looking to get to a 7.1 billion surplus.
The Treasurer said we're back in the black. Hey,
yes, no, not true. Factually not correct, but
projected to be
the budget, which is what he was talking about, is the one where they think they'll bring it back in the black.
So yeah, big week. So a couple of things before we kick into the show. We've got a very special guest today, Ben. But footy tipping. This is for those people who don't like the footy tipping banter the footy banter we talk about.
Yep.
We're going to keep it on a
quick
and update, but the number one tipper for the round, Ben.
Yes, who gets
gets a book.
Gets a book, correct.
And I actually spoke to the number one tipper's husband, David. So the winner is Elaine, right? And when I was chatting to David, said she missed the first game, so got 8 out of 9, having missed the first game, so almost aced it.
Ooh.
And according to David, there was a fair bit of swagger around their household, given that she'd nailed the footy tip. So well done, Elaine, on that.
Yep.
But not only did she nail the footy tips and come in first in round 2 with 8, but also probably right up there in terms of the name.
The best name.
The best name, and it's your fault for this name.
What have we got?
Because Elaine's competition name is Grass Food and Pies. So I've got to set the record straight.
Just missed the little Chinese, me Thursday Chinese in it. But other than that, I love it.
I like food that's alive, Ben. I like to try and have as much sun as I can in the food that I eat. So if that means I'm a grass food eater, but I think arguably if we stacked up the amount of meat that I eat in a week compared to the meat that you eat in a week,
maybe.
I reckon. But you would nail me on pies and chips.
Had a nice pie yesterday, just quietly.
So there you go. But she and also tipped Sydney just through loyalty. Was some of the feedback.
Okay, so
well done, Elaine.
Got a perfect round.
Good job. Picker in the 9th of April.
Quickly, so Adelaide, 9th of April, the night at the Gallery in Adelaide. So that event, register now. Details in the show notes. And Little Smoky, upcoming event in Brisbane, imminent. Couple of weeks later. So keep your eyes out. We'll announce it soon that we'll have our first event in Brisbane as well for Picker.
The Pies playing in Brisbane.
Yeah. So it's either going to just pencil in your diary around the 17th or 18th of April.
Ooh,
so it's
exciting.
It's coming. So just put those in.
Hey, you've been busy. Now's a busy time for you with Picker because the agenda has never been as important as now.
I've got a world exclusive on the podcast today, Bryce.
Ooh.
So it's coming in a matter of minutes.
Okay.
But yes, so I'm off to Canberra in the next couple of days just to basically have a bit of a chat with the media up there in the so-called bubble.
Yeah.
I'm going to the bubble.
You're going to the bubble.
I'm going inside the bubble.
Did you see the skit on the bubble on ABC last night?
That was good. So I'm going inside the bubble, obviously just to raise our concerns around the impending policy. That
I didn't realise we were going. I haven't booked my ticket or anything, mate. So should I make a? Oh no, just you.
Yeah,
okay.
well, I'm wearing my picker hat, Bryce.
No,
so this
enough.
is the volunteer work that I do.
Yeah.
The unpaid work that I do.
Yeah.
So yes, off to Canberra.
And probably a good time in the shadows of an imminent election announcement to say, Ben, that for all of our listeners who are staunch Labor supporters,
yes,
we don't want to be a political podcast. So any influence that we're talking about is only about the policy around negative gearing that the Labor Party has put on the table, not trying to influence anyone in any way politically, other than to say we don't think that this policy makes sense if you are in the world of property investing. So
that's right.
Want to be very clear because we've got a few people writing into us, and rightly so, if they feel that we're trying to balance either way. We're not. No. We're talking about a specific policy.
I'm on record, Bryce. I've said I've voted Labor most of my life. There's only been 3 instances where I've been a swinging voter. Okay, so that is declaring basically I sit in the centre. I don't sit far right, far left. I want the best opportunities for Australian people. I think everyone should have the opportunity to have a go, and I think there's also a fair go in there for everyone as well. So that is a very important point that you make, Bryce. And the same thing, if the Liberals get in, the Liberals get in. If Labor gets in, the conversation does not stop, right? In terms of this policy is bad for jobs, it's bad for the economy, and it's definitely bad for the property market. So, and I'm going to talk to that point because there is miscommunication out there, and that is where in terms of trying to set the record straight in terms of the miscommunication that's going on, and that is a good segue
for the World Scoop
into a couple of exclusives. The first one, Bryce, is last week also, the ATO released their data on investment properties for the 2016-2017 financial year. We got a look at the data in terms of the number of people and what properties that they own. So we're going straight to the Did You Know, right? Because we've got a great, this is a tax show, right? This is a tax show, so we're going straight into Did You Know. So here are the stats, all right? Hot off the press. One investment property, individuals who own one investment property, 71.24%. Now that amount is 1,536,112 individuals who claim rental income on one investment property. Now that could be owned also with their partner, but they're claiming rental income and obviously any deductions that they get against that property. 71.24%, Bryce. So down from the 73 that we've seen in the past, right? Two properties, 18.92%. And that amounts to 407,971 individuals. And that was an increase of 12,000 on the year before. The increase on the one property the year before was 41,275. Now we'll put this table in the show notes so everyone knows. 3 properties moving forward, 125,915, an increase of 3,276. 4 properties, 46,460, an increase of 1,298. 5 properties, 19,500 people, around abouts, own 5 properties, an increase of 641 people out of a population of 25.3 million. All right, 6 properties or more, so 6 properties or more is 20,357 people. So as a percentage of the population who own 6 properties or more, it's 0.08 of 1%. So that's 20,357 people, and an increase in this fiscal year that's been recorded, 16-17, was 390 people out of a population base of 25,320,000 people. All right. So the ownership percentages, 71.2% for one property. For 2 properties, 18.92, so call it 19. For 3 properties, 5.84, call it 6%. For 4 properties, 2.15%. For 5 properties, 0.9 of 1%. And for 6 or more, 0.94 of 1%. Okay, so that's the number. Now, in terms of the exclusive that I wanted to talk about in the Did You Know, we actually have to refer to the communication that came out of Chris Bowen on the Insiders program on Sunday morning. Now, those of you who don't know the Insiders program, it is a political program where they summarise the week's political events. And the interview on that day was with Mr. Chris Bowen, who is obviously the shadow treasurer of the Labor Party. And so some of the information that he's putting out there, I just want to make sure that the community understands if it's correct information or not. So let's go to Mr. Bowen in terms of what he said on that Insiders program on the ABC and courtesy of the ABC Insiders program.
All right,
let's have a listen.
Let's cut to that now.
ATO figures out this week showed there are fewer people negative gearing already. So isn't Chris Bowen the market doing the job you're seeking to do already?
Well, it also showed the biggest increase has been with people with 5 and 6 houses. I mean, the government thinks that it's more important to give a tax break to people with their 5th and 6th house than it is to support people buying their first house.
Well, if that's a concern, excuse the interruption, why don't you just put a cap on the number of houses?
We've considered it.
Okay, so when Chris refers to 5 or 6, it's a couple of things there. Michael Rowlands also highlighted that there is fewer people who are now negatively gearing their properties, which effectively means, and this is what we've always said, negative gearing is a moment in time, Bryce, isn't it?
It changes, absolutely.
It changes.
It's a tax outcome, not a strategy.
Correct. So over time, you go from a negatively geared position to a positively geared position, which you pay tax on. And I'll have more to say about that in the coming weeks as we're running the analysis to show exactly what the difference is. So are property investors tax takers or tax makers is the question here. Okay, so that's the first one. But interesting point there. Less people are claiming negative gearing than in the past. Now that's also a combination, to put that out there, it's also a combination of lower interest rates. That will also help with that. But we're not going to see higher interest rates for some time. So that's probably going to be an improvement to the budget bottom line anyway in that particular year. But then he goes on to say that the biggest increases, percentage gains is what he's referring to, in regards to this policy was for people who own 5 or 6 properties. And they have been trying to push this to their base for a long time. And this is where I'm sort of calling it out, maybe calling a bit of bull dust on this, right? In terms of what it is. So, but he's correct. He's factually correct on one point. And that is the percentage of people who own 5 properties or more grew faster than any of the other categories there. It grew by 3.5%. Or, as we talked about, 641 individuals in this country. It grew by. He was factually incorrect when he said 6 or more. In fact, that was the lowest growth in terms of people owning 6 or more. So he got the 5 or more, growing by 631 people or 3.5%. The second category that grew the fastest was actually 2 properties, and that was 3.1%. So I just wanted to call him out on that, because if you're going to make these claims that all these greedy property investors who own huge amounts of, it's just not factually correct, or it's a bit of what I would call spin in terms of
what's interesting about the numbers you've quoted, Ben, is the first 2 categories roughly a trickle over 90%, right? So 9 out of 10 have 1 or 2, and the vast majority have 1. So what that actually highlights is that people are trying to have a go, and self-fund their retirement, and the excesses of large portfolios are quite small. But what's important, and in my doing this for 20 years, I always come across people who, the uber rich or the people who are excessively well-heeled, they actually generally don't go towards residential real estate. They usually move up to a more sophisticated commercial and industrial, so they don't necessarily play in the resi space. So it's interesting that the people, and I see it as we always talk about, if you want to play commercial or industrial, you should have a few resis under your belt. And for those people who want to invest overseas, we say you should have Australia first.
More sophisticated investors, absolutely.
That's right, but the point is that it's not, and the numbers would tend to back it up. It's even if you've got a person on a excessively high income, the facts are they're only having 1 or 2 properties in bulk anyway. The vast majority of the bell curve is not 5, 6, 7, 8, 20 properties.
Yeah, and all negative gearing does is add to cash flows early, right? And then obviously as it grows, we start paying tax back on that money. So the sad bit about that is the high income earners can keep doing this.
Correct.
This policy.
Probably hence I didn't articulate it well enough, but that was my point, right?
Yep. They can just do it, right?
Yeah.
And unfortunately, the mum and dads who are the school teachers and the people who are working in the service jobs who don't earn big incomes, they're locked out.
Yes.
Right.
You've rounded out the edges of what I was trying to say very well. That's the point, that the people who are trying to self-fund and have a go are being hamstrung. The uber rich, they'll just find another way.
Well, they still get the big tax deductions, right? Because they can also afford to buy the poor performing assets, which is usually the new properties, which I'll again talk about more. I want to get to the next bit, which is this is the exclusive. Okay, so this bit here, as I've said, I've made a recording of this with my picker hat on, but I almost lost my Wheaties when I was listening to this because I couldn't quite comprehend exactly what he was trying to say, because the data was just, first of all, where is that data coming from? And this is where the exclusive bit comes in. So let's take a listen.
We considered all those options when we developed the policy 3 years ago, Michael, but people say negative gearing is necessary to stimulate new construction. Well, at the moment, to the degree that that's true, 96% of negative gearing goes on existing houses, not new construction, so it's a 96% failure rate. If you allow negative gearing going forward, we grandfather all existing investments, but we allow it going forward for new construction. That means instead of 96% going to existing houses, 100% will go to new construction. It'll spur investment.
Hold the phones.
So you didn't catch the show, did you? I'm assuming.
I didn't. I've heard that for the first time, but 96% is ridiculous.
It's wrong.
Yeah.
It's just wrong. So that just led me on a mission to try and work out throughout the course of the first couple of days, digesting that, rang a few people, what's your read on the numbers and where do those numbers come from? And so it appears that the numbers are being quoted from the ABS data that shows the new financing. All right. Now, when it shows new financing, you can break down by investor and you can break down by construction in investor and by existing. All right. So I'm thinking this data's wrong, and we obviously operate a mortgage broking business, and 60% of all new loans are generated through brokers, and I know the platforms that both the banks and the brokers use. And I know where that data comes from in terms of the actual first source of that data. So then I went exploring. I said, so how it works is the brokers and the lenders who are putting applications together in the banks or direct put in a categorisation inside these platforms, and that is then reported into APRA, and then APRA reports that into the ABS. And this is the exclusive.
Oh.
This is the exclusive. That data gets cleansed into existing when it's not, when it's absolutely off the plan or newly erected property. So the broker's putting in off the plan or they're putting in newly erected. And that data is being recorded under the existing property category. So when Mr. Bowen and the Labor Party are saying that it's a 96% failure rate, because all they're seeing in that data is the 4% of construction, and the construction loans are literally the frames and the roof and the actual dwelling that goes on, the improvements on the land. So this is a game changer.
So for clarity, walk us through that. So the broker is putting the correct classification, but it's getting cleansed through to the ABS with the incorrect classification.
Correct. So there's more work to be done here in terms of trying to improve the data insights, because if Labor is thinking that negative gearing is not working because only 4% of people buy the new stock, it's just not possible. I mean, over the last couple of years, the construction of high density apartments, Blind Freddie can see that a lot of that's sold to investors, right? A huge amount of that, and a huge amount of investors buy house and land packages. So that is not showing up in the data. So I feel for the Labor Party if they're thinking the reason that they needed to create the policy this way was based on the data that they were getting, which is just incorrect data. So, in my belief, I think that it's probably 60-40 and maybe even 30-70, where I'm saying that 60 to 70% is actually new stock that's being bought and negatively geared, and 30% to 40% is existing dwellings. Okay, because also you've got to remember, a lot of people who buy existing dwellings buy cash flow neutral or cash flow positive properties, and it's very hard to get those types of properties brand new. So for Labor to think this is one problem. For Labor to then be sending that message out to everyone that the policy is not working is actually misleading. So,
because you think that through logically too, in terms of the people that that are being enticed into the investment space by brand new. The brand new has a competitive advantage over someone like us who is doing established, because the brand new guys can say, hey, look, we can help you for free.
Yes.
Because they're being paid by the developer to give that free advice. Whereas when I'm trying to say to someone, hey, can I help you invest? I've actually got to say, plus it's going to cost you a fee. It's actually harder for us in the established space than it is for people in the brand new space. So it goes against logic.
So obviously, what's the next step? Well, we've let the Labor Party know. We're going to push that out in terms of social media so consumers can have a more informed understanding that unfortunately that's not correct, right? It's factually not correct. We're going to put it on Fact Checker as well, so we can make sure that the Fact Checker section of the ABC can also go and make those inquiries, because this is a data issue. It's not necessarily something that they may know. And in the Canberra bubble, when they're putting these policies together, if they've had that information, I can understand why they might have gone, well, this policy is not working, when factually we absolutely know there's a hell of a lot of new investors who are buying brand new stock. So this is not going to drive more people to buy that new stock. It's just simply not.
Very good, mate. So is there an opportunity for you to talk about this in your trip to Canberra?
There will be. Well, the other thing I'm also talking about is the research that we've done in regards to the performance of new versus existing. Okay, and as the educated investor gets more educated, one, there's very poor secondary market for the new stock in the first instance, but this type of policy will effectively dry up the secondary market completely, and that's obviously what we're also showing. So that flows into the revenue story that Labor is claiming is going to help build schools and hospitals. So there's an important story to be told here, and we're just trying to keep it all factual. We're not playing the man, we're playing the ball. That's the way we want to do this, and if anyone is going to also circulate this information, do it in a kind, courteous manner. Put the information out there. Don't get into any personal debates and ideological debates. That's not what we're here for. We're just here to tell the story, because this has a massive impact to the Australian economy. It has a massive impact for people who own property. We talk about tax cuts. $40 here a week, $40 there a week. That's nothing compared to the 10.1 million dwellings that could lose tens of thousands of dollars off the value of their home. So they might think, well, they're cash flow richer, but they're significantly less wealthier, and I don't know whether people will say that that's what they want.
And you need an army of help, Ben. So if anyone agrees with your views, they should follow you on Twitter and start to retweet some of the tweets that you're going to put out over the next couple of weeks.
We'll keep it as factual as we can, and there's arguments on both sides, but I'm just trying to clear up the arguments, because it's clear that with the industry knowledge that we have and the expertise that we have, that's being lost in translation. So we need to get that into the politicians' hands, and we also need to get that into consumers' hands so they can make an informed decision.
Very good. There you go, folks. Did you know, right at the very top of the show, and I think it was well worthwhile racing it up in terms of our schedule. But today, before we cut to Julia Hartman, who's arguably one of the best minds, Ben, with tax in this country, been around for some time.
Property, she is a go-to.
She is fantastic. We have got so much content with Julia, and based on the fact that our intro is quite lengthy, we might see what it looks like over a couple of weeks. But because we've got so much good content. But the my Mindset Minute theme today is largely around, my wife is very keen on Brené Brown. It's really helping her with mindset. And so she's got JOMO. You've heard of FOMO, Ben?
I have heard of FOMO.
JOMO is joy of missing out, Ben. And this is around possessions and material and getting sucked into the Joneses and all those sorts of things.
Yep.
But the joy of missing out is largely, according to Brené, is largely feeling content, and Andrea texted this to me, feeling content with staying in and disconnecting as a form of self-care. So whilst we are being bombarded with budgets and changes and change of governments and tax breaks and all those sorts of things, there is an opportunity for you to disconnect, not worry about keeping up with people, and actually make sure that that there is that joy of not having that comparison trap. Because once you get into that game, Ben, it's a very, very slippery slope. So JOMO, the joy of missing out, is the feeling content with staying in and disconnecting as a form of self-care. So,
thank you, Andrea, for that one.
Ponder on that one, folks. But as we said, we interviewed Julia last week, Ben.
Correct, after reaching out to our audience. And did we get some questions?
It was fantastic, right?
It was great.
So we got heaps of questions. We're on a mission to give away books and all those sorts of things.
Yes.
But there is just a little caveat here. Hang in there. The content is amazing, right?
Yes,
but we did have a couple of little audio challenges, Ben. So for the better part, 95% is fine. But there's a couple of little screeches here and there. But hang in there, because you get the benefits of Julia, who's been doing this for a long time, and we have got some really great content. We asked our audience, what tax questions regarding property do you want to know? And we'll cut to that interview with Julia now so we can find out. Well, Ben, we often get a lot of questions that are sent in to us regarding tax.
Yes.
And as much as we would love to have a little chat about tax, we are not qualified to answer them. So
the old statement of fact, but that's about all. So we need to bring the experts in.
Well, if I dig into the archives, I've got a degree in accounting, but that doesn't qualify me to answer these questions by any stretch of the imagination. But today we've gone straight to the top. We've got Julia Hartman joining us today.
I would go so far, Bryce, as to say the number one tax expert on residential property in Australia.
Wow. Julia, what do you reckon about that? Welcome to the Property Couch.
A bit, thank you. A bit to live up to, isn't it?
Well, I can tell you that I've been admiring Julia forever from afar.
Yeah.
So, when I started getting, I think I've got edition number 4 of the Australian Property Investor magazine, the good one. And so... And it's just, and there was articles in there which led me to her books, which led me to her, her positions on the different, subject matter expertise that she had on some of the rulings. She just knows her craft.
Julia, sort of episode or edition 4 of the Australian Property Investor, that was a while ago. That's how did that come about?
I don't know. I can't be that old, can I?
But obviously you've been in the property advising circles with your tax background. I mean, clearly you're across the whole tax act, but why have you taken a particular interest in the property side of things?
Well, I guess having property, that sort of got me interested, and I like just dealing with your average taxpayer. That's what my practice revolved around. So generally investments for them are properties. It evolved that way.
And in terms of getting the invitation to comment in the publications way back then, was that something that they reached out to you, or you reached out to them, or a bit of both?
I've got a good story there if you've got the time.
Yeah, I'd love to hear it.
Got the
Come
time.
on.
Okay, I had a midlife crisis, sold my practice, bought a motorhome and took off. Even went fruit picking, right? So I'm there picking cherries during the day, and at night I do the odd tax return for people, and I was making twice as much at night doing tax returns than what I was picking cherries during the day. So I thought, got to get back on the tools. Let's get sensible about this. But after the cherry season, I went down the Murray River and I'm camped down there, and I got my little dog, and we go out and we collect fire and firewood, and I'd set up a fire at night. And I'd sit there with my glass of red wine and my laptop, and I'm on my own. The dog's not a real conversationalist, so I thought I'll write a couple of tax stories, all these things. I just wanted, it felt good to get them down there. Things, basic stuff people need to know. And they were about property. Then I went into Cobram, I think it was. I went into their news agent and I thought, where's a property magazine? Sent it off to Ines. Yeah. And she published it. And I was down that, I don't know whether she liked, anyway, she's
moved on. She's moved on, that's all right.
Sorry, what was that?
She's moved on, so that's
right. We want the full story.
So I was down the Murray River for 4 nights, and this is a long time ago, and I made $2,000 for those stories. So I thought, well, now I know what my calling is, don't I?
Yeah,
That's the way to go. Travel around Australia, sit in front of an open fire and write stories.
Now, my folks live on the Murray River between Yarrawonga and Cobram, so you must have, where was it, Nevins Bend State Forest that you camped in, or where were we? Do you remember the little beach that you were camped on?
No, I just kept on going until I got away from everyone. But it wasn't far from Cobram.
Just remember the
Very
$2,000. Hey, Julia, you've got a Bachelor of Business. You're a chartered accountant and a CPA and a registered tax agent. Now, when I left uni, I went and worked for a chartered firm, and there was the old, chartered versus CPA. But you decided that you'd accumulate both. That's unique. Why did you go down that path?
Well, when I got over my midlife crisis, then we started the band tax group with all the different officers. And to get good staff, they need someone to mentor them through the various professional years. So I needed to have both qualifications to mentor them through whatever they wanted.
Well, that's no small feat to get both. But you founded your practice, which has grown into the band tax group. And when you think of band tax, you kind of think of a different connotation. We'll go into that in a second. But grew back in 1992. It now operates as a cooperative of accountants sharing their varying expertise to provide the resources of a large firm through the personal service of that individual practitioners provide. So we've touched on your travelling, but you spend a great portion of your time travelling around Australia, doing workshops, doing seminars, appearing on podcasts, supporting your office network and mentoring staff. But whilst you're on the road, you're writing news flash, your booklets, blogs, you're developing your website, and you make daily contributions on your Facebook page, as well as having written a couple of books with a very well-known gentleman by the name of Noel Whittaker. So that's a reasonable body of work that you've been doing.
Thank you. Yeah, I do like writing. It's addictive after a while.
Yeah. Can you tell us band tax? Because for those in an audio, that might sound like band TAX, but it's not. It's band TACS. What's the backstory there?
Originally, it started out as Beachmere and Ningi Taxation Accounting Computer Services. I moved the practice from Beachmere to Ningi, and that's when the little light came on. But once I started wandering, I decided it stood for Beachcombers and Nomads Taxation Accounting Computer Services. Oh. And the reason it has a name other than band tax is because the CPAs think it's an embarrassment. So at one of my quality assurance reviews, they had a go at it. But nobody forgets it, and that's all that matters. You don't care, do you, as long as they remember your name.
Yeah, that's it. It's a good point.
Hey, you mentioned, well, you founded the practice in 92. How did that evolve to be what it is now, that you can advise people around all things tax, but obviously property through a network? What did that backstory look like?
Well, a few accountants starting out wanted me to support them, to mentor them. And I saw that there was, and then we started to realise there was economies, and it just worked. There's so many little advantages there, and it's a co-op, because it's not like this is rigid how we do it. We go, oh, well, why don't we do this? This is a good idea, and we'll do it together. Things you could never do as a small practitioner on your own. And most of us are independent. We really don't want to have partners and grow that way, but we need that network of people, network of experience.
Fantastic. Okay, so now we've got a nice little story about the business. Let's talk about your property journey. A bit of a backstory there for us.
Oh, yeah, I suppose so. One of the stories I tell people is the first property I bought, which was way back in the 80s, even before capital gains tax. And friends thought I was mad. I borrowed $80,000.
What? Come on, you did not.
$20,000 on a personal loan, and $60,000 as a housing loan, and 13.5% interest rate. Horrors,
What were you thinking?
Oh. So the property cost $96,000, and a year later it's worth $250,000. I'd pay 13.5% anytime. Give me those days again. Love it.
But are you practicing what you preach in terms of, you obviously look after hundreds and educate thousands of property investors from a tax point of view? So does the portfolio still remain? Have you been able to rebuild or hold any properties at all?
Oh yes, yeah. I bought another property and I subdivided that and a few things. But no, I don't like tenants over it. When I had that midlife crisis, got out of everything. I've got a little bit of rental income. One tenant I've had for years and years and years, and another one I Airbnb, and that seems to be a lot less trouble as far as they really vet their people, and that's it. There's other things to do that are a lot less trouble. I know that's probably not what you want to hear.
No, we want you to be authentic. We want to hear exactly what you're talking about. Clearly, you don't have to be, one of the guys in our office says you don't have to have a heart attack to be a cardiac surgeon, right? So the fact that you're a specialist in tax and understanding property doesn't mean that you have to hold 20 or 30 properties. Hey, can you, given that you've been involved in property tax matters for so long, can you maybe share with us some stories of clients that you've seen on the good side and the bad side in terms of, some are, Ben and I have got plenty of stories where we know people who have been stung and burnt and bought the wrong stuff and held property for a long time and it hasn't done anything for them. Over your time, what sort of stories and scenarios have you seen where you've just sort of, your mind's boggled and you've gone, what were you thinking?
Well, it's what they've been told to think was what worried me more. This was a lovely couple, and they went to one of those seminars back in the days when you could get people to go to those seminars, and they came out of there feeling that, first of all, there'd be no pension when they retire, and that they owed it to their children to invest and provide for their own retirement, and it would have been irresponsible for them not. They really played on the fear and the conforming and your obligation, and that's why they went into this property. They just thought that's what they had to do. They'd be bad people, not. That really bothered me that they'd been manipulated that way. Anyway, when they finally, because you don't go and see your accountant before you buy property, do you? No, they'll fix it up afterwards.
You don't
They
get
can do
advice
something
from
there.
a professional. That's crazy.
So when they came to see me, and it was a couple of years down the track, I think they must have changed accountants or something. Anyway, they'd been set up. They thought they could afford the property, and they just signed all the documents they were given. But in actual fact, there were two loans in place. One was available line of credit. So what was happening was some of the repayment on the property was coming out of this other loan. So they were getting deeper into debt, and they didn't even know it. It was just so sad because before this happened, they paid off their home. Then they couldn't afford to keep the property. They had to sell it, and they then went back and had to pay down their home again before they could retire.
So what happened was they got two loans. One was a line of credit, and obviously that had a limit, and so they were drawing on that limit, and they were thinking that everything was kosher because they may not have been totally financial literate in terms of what was happening there. And they got themselves to a position where that debt got so high that the household budget couldn't be maintained. And they've come into you and unfortunately they've said, can you help? And your story was, well, you should have come and seen me a little bit earlier, and maybe you wouldn't have bought this property. And that's a common thing. We see it all the time in regards to the spruikers who prey on fear rather than the fundamentals of, sensible long-term investment from good asset selection. So it's a timely story, but whether that happened in the 80s, 90s, the 2000s, or in this current environment, it's incredible to see so many people who continue to fall victim to bad property advice.
I hadn't thought of it until now, but that's probably one of the things that motivated me to start writing, really.
Yeah, you're sick of seeing people get stung. I mean, you've been around since the 90s, so you've covered 3 decades. Have you noticed any trends in people more likely to come and seek an accountant's advice before investing in property, or are you seeing it status quo, or are you seeing it actually being worse?
Yeah, no, definitely more likely.
Mm-hmm.
Yeah, and maybe that's because of my profile that they're coming to me that way.
Yeah.
But you still do get them coming in and saying, I bought a property this year.
Yeah.
So with all of that wealth of knowledge that you've got and all of those clients that you've looked after, as an accountant, you get to see the financial stories, and no names, no pack drills, but you would have seen some unbelievable property returns with the valuations of properties to work out capital gains tax, but you also would have seen some shockers in regards to they've had this property for 10 years and it's gone nowhere. Is there any type of property that you've, in the factual stuff that you've been looking at, it says these properties seem to do better from capital growth point of view, these types of properties seem to do better from a yield point of view, these types of properties seem to do worse? What's your observation for the listeners in terms of the types of properties that have done the best work for you?
Right. Well, I'm now reflecting again on my own because I have had a few. Like I said, I just get over tenants, But I like being a slumlord, I think, because you're looking for the land value, and you're probably buying, because they're older properties, closer to things that are valuable. And one particular property was just four old flats on 2 blocks of land right near the I'm trying not to identify it, right near the bay, and then across the road from a bowls club and a bus stop out the front. Pensioners couldn't have afforded to live there. They can't get anywhere else to live than to be in such a nice area for such cheap rent, and you still got your same capital growth happening.
And what
I'm
about
a bad landlord, I'm afraid.
No, that's all right. I mean, obviously that's your story. What about your client stories? I mean, are you, as I said, you get to see a lot of tax returns that you've got to work out, a lot of capital gains that have been made. Is there? Are they just an address that has no meaning to you, so you can't picture them, and it's hard to work out why this has been such a good return over a short period of time or a great return?
Oh no, with all my travels, I can picture most of them. It's really got to be lack of supply, Shaki.
Yeah, the key motivator for growth. Yeah.
Hey, given your profile, Julia, in this space over 3 decades, have you had spruikers approach you to try and move their stock on their behalf?
Oh yes, we get them quite regularly because of our profile. Yeah.
Has your response changed over time? Do you get a bit more flippant with them now, or is it the same approach?
A polite decline or a buzz off?
Well, I'm a publicity tart. I'm always out there to say I'll give you some articles or this sort of stuff. Yeah. But no, I want to remain independent. Generally, my response.
Good. So, hey, let's dive into some questions. So, what we did, Julia, is we sent out a little note around our socials, said that we're getting you on. Who's got some tax questions? And we were inundated. So, if you can help us, we give away a choice of our book to anyone who asks a question. So, if we can get as many done today as we can, means we can give away as many books as possible. And we'll also put some details in the show notes on how people can get access to you and get access to your books and those sorts of things as well. And if you wanted to send one out to some of the listeners, we'd be happy to do that. But the first one here is from Joshua Field. If I have purchased a block of land but choose to on-sell it prior to settlement, but the new purchasers don't settle, would I be taxed on the 10% deposit the new purchaser pays in the event that they don't follow through with the sale, leaving me to settle the land?
Yes, you would, and there's no 50% capital gains tax.
Exemption, yeah.
You haven't got the 12 months, yeah.
Yep.
Now, you were saying about my book, it's very out of date now, and I'm not going to write another one for another 2 years the way things are going. So you're welcome for me to give them away, but I can tell you there's some chapters in there that'll always be good.
Yeah, there's some evergreen stuff, I'm sure. So look, we're happy to give ours away. We're more than happy to try and get rid of as many as we possibly can into the hands of our audience. But I don't know if getting rid of is the right term for it, Ben, but we certainly want to pay it forward.
Educate.
Hey, you touched on, and it might be a nice little segue here, you touched on the capital gains tax exemption 12 months. Do you want to give us a quick 101 on that for the listeners so they understand exactly what that means?
Right. So if you own a property for more than 12 months, you're entitled to, or any asset for that matter, you're entitled to the 50% capital gains tax discount, and it's measured on the day you sign the contract and to buy and the day you sign the contract to sell, and it's got to be more than 12 months. So there's got to be 12 months and a day in between. And
you make a very good distinguishing point there that it's the contract date, not the settlement date. All right, I've got one here from Brendan Gale. What is the threshold between claiming all renovation / maintenance in 1 year versus having to stagger it over X number of years?
Well, it's not actually a threshold or even a choice matter. Maybe he's referring to the $300 immediate write-off for plant and equipment. So you've got to add all the items together. But if you've only spent $300 on curtains that year, yes, you can claim it straight out as a deduction. If it's more than $300, it's the effective life. But we're still only talking about plant and equipment here. When it comes to the rest of the renovations, then they're going to be written off over 40 years. You're only going to get 2.5% a year, unless they're repairs that didn't need doing when you buy the property. Then you get an immediate write-off for them.
So this is always fun, isn't it, in terms of interpretation of what's a repair versus what's a replacement. Can you give us some fun examples over the journey for yourself of where a client's coming to you and said, I want to claim
It was a
X.
repair. It was a repair. It's not a replacement.
It's not a replacement. What are some of the fun ones people try on?
Well, they say, no, it didn't need doing when I bought it, is the big argument. I say, did you get a building and pest inspection? Oh, yeah. Is it in there? Yeah. Needed to. On the other hand, the tax office will try and argue that it's not a repair if you replace the whole roof, because that's a replacement in its entirety, they try and argue. That's not the case, because you need the walls of the house to hold the roof up. The entirety is the whole house, so it is a repair, providing the roof didn't need repairing when you bought it.
Fences I've also had some challenges with in my journey as well, in terms of, the thing was falling over. Was the whole thing falling over? And it's like, well, yeah, it sort of was, right? So, have you ever had, people try that one on? I've certainly tried on with my accountant.
I was saving that until the end when we were going to discuss what's a good sign of an accountant. That's the only reason I didn't use it. All right, there's actually a tax office ruling out that says that even though you might, as long as you don't replace the entirety, the whole fence, even though you might replace a little bit here now, and in a year's time another bit and another bit, and eventually the whole fence is replaced, as long as it's done in stages, then it's a repair, providing it wasn't falling over when you bought it. Now, I did a seminar once and I got caught questions. Someone said, well, you've got 3 fences here around the property. What's the entirety? The 3 fences or just the one side? And I just looked bewildered, and luckily there was a builder in the audience, and he said, I think I could answer that. He said, the posts on the corner support both sides of the fence, and if you took one side away, that side would fall down most of the time. They're sort of reliant on each other. So he could argue that the entirety was all 3 sides of the fence.
There we go. So no private ruling there, just go for it.
There is a tax office ruling, but not on what the builder said, but it makes good sense, doesn't it?
Yeah, it does make good sense.
Because the other one comes around painting, doesn't it? In terms of painting for repair versus redoing the wall with another colour. So that's the difference between maintenance and repair on those sorts of things. Improvement versus repair on those sorts of things. So you have to interpret a fair bit, or do you think it's pretty straightforward? It's pretty black and white.
Well, it's not straightforward. In fact, some of the cases they actually tend to contradict themselves. So there is one where the polishing of floorboards, ripping up the carpet, polishing floorboards, was considered to be a repair. So that puts you change the colour of paint out the window, doesn't it? So that was considered to be a repair. But the building started to subside, so they had to underpin the foundations, and that was considered to be an improvement. So no, I can't. You try your best.
Hey, Julia, the next question I got here is from John Fryke. If 5 family members own one investment property, can the income be all directed to one person, or must it be 20% each?
Yeah, it's got to be apportioned on the basis of ownership, but one owner can rent their share to the other owner. So if someone to live there, they can actually rent that part off.
Can you do, as part of that, just a quick talk about the difference between joint tenants and tenants in common? Because you can actually have you could have 2 people as joint tenants who are tenants in common with the other 4, for example. So can you the other three. So can you explain the difference for our listeners between joint tenants and tenants in common, please?
Right, so joint tenants is if one of them dies, or say there's three of them, or then one of them dies, the other two get that person's share. There's nothing going through the will or anything like that. Whereas tenants in common, when that person dies, it goes to their heirs through their estate. So normally joint tenants is for couples.
Yeah, that's right. The best way to describe it is, my own home would be joint tenants with my wife, so the rule of survivorship applies. And if I was to pass, she'd automatically get it. Whereas if I bought an investment property with old pink shirt here, we'd go.
That's me.
We'd go tenants in common, so that he could put it through his estate if he was to pass, and then the same for me. But it's an important distinguisher, isn't it? Particularly from your perspective, when you're preparing tax advice.
Yes, well, it's assumed if you're joint tenants that you just own it in equal portion. So that's how we divvy it up with joint tenants.
Yep, terrific. All right, I've got one here from.
I like the way this one's proposed as hypothetical question, because don't say his full name, because it might be more than a hypothetical question.
You love to read out questions.
Oh, I'm great at questions. I have a principal place of residence, and I decided to build an extension and use it to rent out, Airbnb or lease to a tenant. Is the deductible percentage based on square metre only? Any other considerations that should be made, such as a common garage? Does that make sense?
Yes, it's all written in IT 2167, and certainly the room that's used by that person, that's your square metre. But they obviously share common areas like the garage, and that says that you've just got to apportion that. Say if there's two people living in the house, then you'd say, well, the garage is 20 square metres, so we'll only say 10 square metres, and that gets you the percentage of the area of the whole house that you can claim on your rates and your interest and all that stuff.
So when you go and see an accountant with this information, does the software with the accountant firms, where do you put those sort of file notes? Because once it's set up, you load a property into that particular individual's tax return. Is that then just sort of automatically set until the client tells otherwise, that I'm no longer, renting out that particular space, or how does that work?
Yeah, well, it depends what software you're using. Some of them have a cost put in the private portion, so you percentage it up like that. But you've got to still override it. It's not sense to forget, because obviously if you pay a real estate to advertise it or something, then that's 100% deductible. That doesn't have to be a portion. Not all of it would be a portion.
Yep, got it.
There's a part B and a C on this. So part B is, will the build be able to be depreciated as capital works deduction?
Yes, but that'll also reduce the cost base for capital gains tax purposes, whatever you claim and you don't have a choice, you've got to do it. So, yeah.
Okay.
So let's explain that in terms of when we are talking about cost base versus when people make decisions to rent a portion of their home, that's going to impact a portion of the capital gains event. Do you want to just explain that in a little more detail for the listeners around the consequences of doing such a thing?
Right, okay. So assuming it's been covered by their main residence exemption up until they make that decision,
Yes.
Then once they make it available to rent, that's it. Section 118192 resets the cost base to market value at that date, and they're deemed to have reacquired the property at that date. Then once they're starting to earn rent from it, they do that percentage that we've talked about, but they've got to then work out when they sell the property how many days it was fully covered by their main residence exemption. Now, because the market value has reset, there's been a market value reset of the cost base, we're not even interested in before that. That's all exempt because it was fully covered by their main residence exemption. So We're looking at it now. Let's just say, I think an example might be the easiest way here. Let's just say half of it's rented and half of it they're living in as their home. So they go through and say for a year, 50-50, and then for another year, they decide they don't want a tenant and they're living in it as just their home, completely covered by their main residence exemption. So at the end of 2 years, 25% of the capital gain would be taxable, and that's clear, isn't it? Because half of 1 year, half of the time. And the trick here is, I don't know whether you want to go this far.
No, keep going.
You can increase your cost base by anything associated with the property that you haven't otherwise claimed a tax deduction for. So during that 2-year period, 75% of the insurance and the interest on the loan and rates and whatever hasn't been claimed as a tax deduction. So the way the formula works is you increase your cost base by that amount, then you apply your 25%. So you can see proportionately some of the costs associated with the part you were living in reduces the capital gain on the part that you weren't living in. You calculate the gain first. I'm getting blank looks here.
No, we've got it. Yeah, it's...
Yeah, right.
Well, I think it highlights the point that there's some intricacies that that mean that you need to take advice from this, right? Because we've been doing this for 20 plus years, and where that look was just a concentrating wince, because there's a fair bit involved, right? And hence the reason why someone should not only come and speak to an accountant when they're trying to buy a property, but they should also speak to them if they're trying to do anything that is more than just living in it for their own purposes. So no, I mean, so that I guess, would you see that clients underestimate the impact from a tax perspective and what you just talked about when they I'll just rent it out, and then all of a sudden they come to you and you tell them the fact that it's no longer just a principal place of residence exemption? Do you see the same look you just saw from us, and maybe a little bit of the colour come out of their face?
Yeah, I had one come in and tell me that, and I said, you've just reset your cost base to market value, and the market's right down at the moment, so you've dropped it, you've lost your stamp duty for buying it, because that's all forgotten now, and the colour started to drain. And he said, well, it's only a mate, And I said, and is your mate getting rent assistance from Centrelink? And he went, So he went back and he gave him back the rent money, he said. He said, and you go and give that back to Centrelink, because he says, I'm just not having it.
Yeah, clever. I mean, but it does highlight the importance of timing when it comes to your principal place of residence. If you're, the 6-year rule, we have talked about that before on the show, around that you can leave your principal place of residence, and the gain that occurs over that 6 years, if it remains your principal place of residence, can be reassessed on the 6th year, but you can have it as a rental property during that time. Do you want to just share a little bit more expertise in that area, Julia?
Well, the biggest trap that I worry about with that is that some people, that won't help when you've got a friend coming in and staying with you, or that section requires you to cease to cover it with your cease to have it as you've got to be absent.
Yes.
So if you have people share, you don't get to use that.
No, sorry, my bad. Yes, I sort of segmented that into a shared arrangement here, which is not the case. You're absolutely right. They've got to completely depart that property, which I think that finishes off in regards to the question from Alistair in regards to, when he says the final part of that was, when I sell my principal place of residence, it won't be without capital gains tax. Will it only the same square meterage that is subject to GST, CGT? The answer to these questions makes it clear if it would be worthwhile as a proposition. So I think we've sort of got that information in regards to what we were just talking about.
Agreed. So thank you for that. Next one from Andrew Odell. When selling an investment place, how is the depreciation you have claimed on the investment property affect how your capital gains tax is calculated?
Right. Well, first of all, there's 2 different types of depreciation. One's on your plant and equipment. So the plant and equipment depreciation that you've been able to claim does not go in the capital gains tax calculation. So I know you don't see it happen in real life, but what's supposed to happen is you paid $400,000 for the property, and you start depreciating the plant and equipment, which is $20,000, right, and writing that off over their life. So your cost base for capital gains tax purposes is $380,000. You then sell the property for $500,000. You've still got $10,000 in stuff you haven't written off in the depreciation schedule. Your selling price for capital gains tax purposes is $490,000. So plant and equipment is out of the pool for capital gains tax. Right, so then, That's the way we do it in effect. I mean, it's supposed to be the market value, but you're not going to get the market value, so you just use your depreciation schedule. Now, the building depreciation, which is your 40 years, your 2.5%, if you bought the property after the 13th of May 1997, then you have to reduce your cost base by any depreciation that you could have claimed during that time, even to a certain extent if you didn't claim it. But the tax office has given some concessions there. If the amendment period has expired, you don't have to write it back if you didn't claim it, that sort of stuff.
Do you?
Sorry, something just jumped straight into my head then in terms of, but what about the new rules around existing properties where you can't get depreciation? Are they, surely they can't argue that if you haven't claimed it, bad luck, we're going to add it back to the cost base?
No, well, that I was talking then about building depreciation, which you still can. The new rules haven't affected building depreciation.
Yeah.
Julia, are you? Do you advise your clients that they need to get a quantity surveyor's report to unpack the depreciation, the full depreciation, or is that something that you like to calculate?
Okay, depends. Obviously, the law requires if they don't know the original building costs, then we've got to get a quantity surveyor in to do it. But I do, if they can get it off the builder, they can do that too. I've also managed to get it out of a body court once to sort of save them the money. But yeah, it's got to be someone qualified to apportion, to say that's how much the building cost to build back then. Accountant can't do that.
No, and I think it's just right to, this is a high value asset. So, get your depreciation schedule and get the claims that you want to make because it's going to add to your cash flow. And cash flow is king when you're acquiring property. So, and hopefully if you bought really good ones, you'll never sell them either. Yeah. So, that'll be a problem for your kids in regards to any capital gains event that's going to be had as part of the estate distribution. Right.
Yeah, and any add back really only gives you the 50% capital gain. By the time you got the 50% capital gains tax on that, you're going to be in a lower tax bracket anyway. You'll be fine.
So this one's from James Barker. Are stamp duty and capital gains tax affected for first home buyers when purchasing a property for the purpose of investment versus owner-occupier? Also, if the property is initially purchased as an owner-occupied property but later turned into an investment property, what is the tax outcome of this both throughout the life of property ownership and when the property is sold further down the track? So it sounds like first he's trying to buy it first with concessions and then turn it into investment property down the track.
Yeah, the point is, has he moved in there as soon? Because he's got up to 12 months to move in with the concessions. But to get his main residence exemption from day one, he needs to move into it straight up or renovate it. He can't have someone else live there. He can't buy it with a sitting tenant. He can't rent it out for 6 months and then go in and get, even though the state governments might let him for the concessions, it won't work for capital gains tax. So assuming he's been smart enough to move in there from the start and then he rents it out later, then that section 118192 that I was talking about before resets the cost base to market value at that point and deemed acquisition. So anything that happened beforehand doesn't count. It's all right. But counter to that, if he rented it out first, then he doesn't get that, which means we go right back to day one, and he actually has to reduce his cost base by that first homeowner's grant receipt.
Okay. So even someone who's trying to do that needs to seek some accounting advice.
Every time, yes.
Every time. All right. Anything there, Ben?
No, all good. Very good. What have we got? Karen next?
We've got Karen. If I move out of my principal place of residence and turn it into an investment, then sell it after 6 years, how is capital gains tax calculated?
Okay. Now, we've done it to death. There's 118192 reset to market value. At the time she advertises it for rent. So if we forget about every time before that, assuming it was fully covered by her main residence exemption. But she says after 6 years. So we all know the 6-year rule that she can continue to cover it with her main residence exemption while she's not living there, as long as she's not trying to cover another place with her main residence exemption. But by saying after 6 years, I think she's thinking, well, what if I go to that 7th year? What's the consequences? Well, you've got to go back to when she first rented it out and calculate the capital gain for the whole 7 years. And then you say 1/7 of that gain I calculated is subject to capital gains tax, gets the 50% discount, goes in the tax return.
All right, well said. There you go, Karen. I'm just reading them all out so we can give away books too. So we'll make sure we cover them all off.
So for clarity, I just want to so let's say that 7th year, that extra year, you were just saying that it's 1/7. So at the end of that 6 years, should they get the property value? So should Karen get a property valued at that point? Or no, it's however long you hold it for, you don't need to get the property valued at that point?
Yeah. That's a lot of confusion. It makes sense to a lot of people that, when this happens, there should be a reset. And when that happens, there's no sense in tax. The only time you're really going to get a reset to market value is when it's been covered by your main residence exemption from day one and you start to earn income from it. That's a point. Or death and you've inheriting a property that was a person's home. Other than that, no point in valuations because you're never going to get a reset.
So the gain that you've had over those first 6 years, let's say the market's absolutely booming, and you then the market's then flat for the next 6 years when it's not your principal place of residence. The first 6 years it boomed, the second 6 years it didn't boom. You're still going to take an average of the 12 years. You're not going to have the first 6 years and then a market valuation and then the next 6 years.
No, not if you're saying it was rented the whole 12 years. That's what you mean, no.
Okay, fine. And what about if I move back in on the 6th year on month 6 and I lived in there for another year, and would that reset my 6 year rule?
It would reset your 6 year rule, but it wouldn't reset your market value rule.
Got it. Yep.
Oh, very good.
Excellent.
I got another one here from Josh Crafts, which is very much in the same school of question, but it's just so that we can give out a book. So it may or may not need too much more commentary, but can I claim any ongoing CGT discounts if I move and rent out my principal place of residence if I move into a rental myself?
Yeah, I was a bit confused about what he meant about the CGT discounts. I'm thinking that maybe he really means, do I get my main residence exemption?
Yeah.
So just to make sure, the same thing as the 6 year rule. Yes, he can continue to cover it with his main residence exemption because he's renting somewhere else, so he doesn't want to cover that with his main residence exemption. And he can continue to do that for 6 years. But if we're talking about the 50% discount, here's a little known trap. Is that resetting, and it's not optional, resetting to market value when you first rent it out also deems you to have reacquired the property at that date. That's why we don't go back and look at things before that. So if he moved out, rented it out and sold it in less than 12 months, any gain between that market value and the selling price would not get the 50% capital gains tax discount because he hadn't owned it for over a year.
Oh,
okay.
I've learned something today.
Yeah, look at that.
That's a little. I didn't know that.
Put that in your pipe and smoke it,
Yes,
Kingsley.
that's.
Well, there you go. So thank you, Josh. You've certainly uncovered a little bit of gold there, so we appreciate that.
I like it. So if you're going to rent a property out, rent it out for 13 months. I think is the message there, or 12 months and 1 day.
Yes, absolutely. So this one's from John Townsend. I'll be looking at losing close to $80,000 on an investment property I've held onto for 12 years. Just wondering how long I can carry this capital loss over for and how the whole offset process works, i.e., would an 80k profit in the future completely be offset against this loss? Over to you, Julia.
Yes, there's no limit to how long he can carry forward the loss for. It goes on forever. He has to, the minute he makes a capital gain, he has to offset. So if he has no other income and he's only made a 20,000 capital gain, it's a bit of a waste, but he still has to offset that 20,000 and then carry 60,000 forward. The offset also happens before you take the 50% discount. So if he made 100,000 capital gain before the discount, offsets the 80,000, 20,000 left, he can then get a $10,000 capital gains tax discount. He only gets half of what's left after offsetting the loss.
Oh, that's a key distinguishing point.
Yeah, good.
And it's also important to know you can only offset a capital loss with a capital gain.
Oh, yes.
Correct.
Yes.
And a lot of the times we also get questions around what if it was a share capital gain versus a property capital gain? Is there any distinctions between the asset class that you're claiming the capital gain carried forward loss? Does it have to be the same asset class, or can it be anything?
The only distinction in class is that between personal use assets and collectible. No, yeah, you can't offset a loss from a personal use asset anyway. You don't get to carry that forward. But collectibles, again, are segregated. But your share loss and your property loss, they can offset. Your property gain, your share loss can offset, and vice versa. It's only these personal things like personal use assets and collectibles that are a different class for that purpose.
Oh, very good. That's great information.
Makes sense. We again, I think we've answered this one, but just in the interest of giving away some books, Richard McDougall. I recently tried to work out how to calculate capital gains tax, how much I would pay on an investment property, but the ATO's website made it very hard to do this. Is it just a straight 50% of the profit made, or does it matter how long you've held the property, or does the profit then go into your yearly income and the percentage is worked out that way? I think we have covered that off, but I think you've got a capital gains calculator that we can put in the show notes so that someone can go and do that if they have any queries. But is there anything other than the 12 months and 1 day for the 50%, and also netting off what you just described on the previous question that we can add value here, Julia?
Yes, that's right. You just offset your losses, take your 50% capital gains tax discount, then that gain is added to your normal taxable income. So depending on what tax bracket that pushes you into, that's the rate of tax you pay on the gain.
Terrific. All right, we're getting through a few here, Ben.
We are.
Now, we've pivoted here to some, I guess, broadly ownership and trust-related questions, because we get a lot of those. Julia, what name should I buy in? Should I buy it in a... All right, mate, how good was that?
She is great, and I can't wait till the second instalments. Yeah. I mean, there's so much great content that we decided to pull it over 2 episodes.
So we're going to do some more next week, which I'm looking forward to.
Which also allows us to, talk about what the Labor Party's reply has been, my time in Canberra, what did I learn, those types of things. So we'll be able to give a nice update, because this is all tax related. It's all tax related.
Yep. So the next one is really, we've categorised them, so trust and ownership structures and the like. So it's going to be a good episode. So hang around for that next week, folks. We'll give you more from Julia. But today, Ben, my life hack. I've been going through the money smarts for my recent life hack. So I'm just going to do a little pause on that because I think it's really important. But today, I'm actually doing a life hack that is for me. Yep. It doesn't apply to you because you don't.
How do you know?
Because you don't go down the same slippery slope that I do. I'm addicted to distraction. You're not, right?
Oh, yeah. It depends on what the distraction is.
All right. Well, maybe this might work for you then. But I'm going to say my life hack today is to hide the social media slot machines.
So that's the 3 of them?
Well,
how many are there?
The thing is, the social media companies get away with peddling hits to our endorphins.
Yes, they do.
The same way that a drug dealer does, but it's socially acceptable for a social media company to do it because it's legal. Whereas if we get the same from a drug, well, then it's not the same, right? So I'm going to help you hide the social media slot machines, and for me, so clearly I'm iPhone IMUS, but we can use this for Android for you as well. But step number 1 is to remove the social media notifications.
So the little things that
pop up,
the little numbers,
right?
Yep.
So I have removed that for some time, right?
Yep.
But that is the drug. That's the hit, right? That's what gets us in. Yep. So that's number 1. Remove that. Yep. Number 2 is we remove this. Put all of your social media icons into one folder.
Yes.
Okay.
Yes.
Step number 2. Step number 3.
I've done that bit.
You've done that bit.
Yep.
Step number 3. Take that folder off the home page.
Nice idea.
Throw it to the second page, because then if you're ever susceptible to the drug hit, and change the name instead of social, change it to leisure. Because you do it in leisure time, right? Not, or if you're a really hardcore productivity person, change the folder to waste of time, right? But whichever persuasion you are. And then what step am I up to, Ivis? Was that 3? Step 4? Step 4 is when you get into the social media icon, the folder on page 2. Yeah. Do you know that
called waste of time?
Called waste of time. Is that, so yeah.
Yeah, I'm listening.
So do you know that when you put them into a folder on iPhone, obviously you nod or shake your head if this isn't the case on Android, but you say you've got 9 apps, the 10th one goes onto a second page within the folder. Does it do that on Android as well? So, all right.
Got it.
What you do is you throw all of your app notifications within the folder onto the second page and leave LinkedIn as the only one on the first page. So you have to have one in the folder on the first page and then all can go on the second page. Because then when you go onto the second page, Ben, then you go in and have a look at that folder. The only thing is LinkedIn. Why LinkedIn? Because it's the least addictive, right? And then all the other ones are on the second page. Because even if you cannot face the idea of turning your notifications off, Ben, you've now life hacked yourself. You can leave those notifications on because it's either waste of time or leisure, it's on the second page, and all of the ones with the notifications are on the second page of the folder within it. So there you go.
Mate,
Hide the social media slot machines is my life hack
I love
today.
that. I love that. I've been on social for a bit over the week because, you know, I'm becoming a little bit of a keyboard warrior to just get the message out there to sort of right the wrongs as I see them. So, you know, that may continue a little bit. So I think I need to do that. I need to sort of organise it. So thank you for that tip. Wonderful.
So this is the point where I normally say, did you know, Ben? But there's an opportunity here. Have you got,
Well, there
is there anything else you want to talk about?
I've got a did you know, but this is about...
Who did you know?
I've got another did you know, and this is about a little bonus opportunity. A little bonus opportunity. So for those people who have looked at the seller hold, who have those properties that they just don't know about, we've had a great response of people setting up their free accounts and loading their information on their existing properties. But we are going to give, because we had our introductory 20% off, now we're in the month of April. This is no fool, Bryce. This is no April Fool. You are going to get 30 minutes of time with Jeremy Shepherd to analyse your property. You get he's dropped his pen.
Drop the
30
mic.
minutes. So if you purchase the seller hold review in terms of going there and compare your property, not only will you'll be able to do that with Jeremy Shepherd. So you can book a time in with Jeremy.
Hang on. The Capital Growth King is coming out of the lab.
He's coming out of the lab and he's going, because there's a lot of information here, and some people are watching the tutorials and going, oh my God, how do I interpret all this? But Jeremy's going to show you how. Okay. So it's well worth only for April.
Yeah, I was going to say
only for April, right? Because he's going to pretty much have a limited amount of time. So you've got to act quick. Get in for April.
Get him out into the sunlight, folks. He's normally in the dark.
That's right.
In the dark.
Purchase your seller hold review, and you're going to get 30 minutes time with Jeremy, where you'll go through the numbers and he'll show you how to compare the alternative markets. And together, you're going to get so many more insights in terms of whether you sell or whether you hold, because there's no use in holding on to a lemon if it's going to be a lemon for a long period of time. But some people might be going, just peace of mind. You're basically buying peace of mind with the creator of Seller Hold, Jeremy Shepherd. So get on board, go to the show notes, and away you go.
All right.
So that is another wonderful.
Hey man, is this a precedent? Obviously, we're doing Did You Know, 2 Did You Knows per episode now.
I think we should.
Well,
I think I should lead the show off. What do you reckon?
We'll never start on time ever again.
Should I just lead the show?
Should we let the listeners know what that means? We get in here and we go, right, we're prepped, Ibis is ready, I'm ready. We go, Ben, how'd you go for Did You Know? And you're like, the colour goes out of your face.
Bryce, no one's here anymore. All right, so let me just wrap it up. Knowledge is empowering, Bryce, but only if you act on it. See you next week, folks.